Welcome to the Share Capital Prospectus presentation. Let's dive into the essentials of share capital and its implications. Our agenda includes an introduction to the prospectus, approval and availability, contents of the prospectus, timing and issuance, expert involvement, and liability and compensation. We begin with an introduction to the prospectus, a crucial document for public investment. Basics of prospectus. Definition and purpose. A prospectus is a formal document issued to the public inviting subscriptions for securities, essential for facilitating informed investment decisions. It encompasses details about the company, its financial standing, and the securities offered, aiding potential investors in assessing risks and opportunities. Types of prospectus. There are various types of prospectus, including the standard prospectus for initial public offerings and the shelf prospectus, which allows companies to offer securities multiple times under a single document. Each type serves distinct regulatory and practical purposes in fundraising. Importance for public offerings. The prospectus is crucial for public offerings as it provides transparency and protects investors by detailing the business's operations, financial health, and the specific risks involved. It ensures that companies adhere to regulatory standards while fostering investor confidence. Shelf Prospectus and Supplements. Concept of shelf prospectus. A shelf prospectus serves as a comprehensive offering document that permits companies to make multiple future offerings over a specified time without needing a new prospectus for each issuance, thus facilitating greater efficiency in capital raising. Role of supplements. Supplements to the prospectus are issued to invite subsistent public interest for previously offered securities. Each supplement is crucial for updating disclosures to reflect new information pertinent to the investment. Updated disclosure requirements. Continued disclosure requirements mandate that any material changes affecting the securities must be communicated through a supplement. This keeps investors informed and compliant with regulatory obligations. Next, we discuss the approval process and availability of the prospectus. Approval of prospectus. Conditions for approval. The approval of a prospectus by the Regulatory Commission is contingent upon its compliance with legal requirements and accuracies in disclosures, ensuring that it meets the standard for investor protection before public circulation. Validity period. Once approved, a prospectus remains valid for 60 days, after which it requires reapproval if still in use. This period is critical for maintaining updated and reliable information for potential investors. Submission process to Commission. Companies must submit the prospectus to the Regulatory Commission at least 21 days before publication. This process includes detailed personal information about the offering and the company's financial status. Availability of prospectus. Publication requirements. The prospectus must be published in widely circulated Urdu and English dailies, ensuring that it reaches diverse segments of the public within a specific timeframe before the subscription starts. Distribution of copies. A sufficient number of printed copies must be available at designated offices, including banks and exchange offices, facilitating easy access for investors interested in purchasing securities. Online access to prospectus. In addition to hard copies, electronic access through the issuer's website is mandatory, ensuring that the prospectus remains available for the duration of the offering. Now, let's explore the essential contents of a prospectus. Essential information. Regulatory requirements. The prospectus must meet all regulatory standards set forth by the Securities Act, including comprehensive financial statements, management discussions, and forward-looking statements about the company's prospects. Risk factors disclosure. Specific risks associated with the investment must be explicitly disclosed in a separate section, allowing investors to make informed decisions based on potential challenges that could impact their investment. Investment decision support. Comprehensive details on company operations, financial health, and planned use of proceeds from the offering are crucial in helping potential investors evaluate the attractiveness of the securities. Role of regulatory bodies. Commission oversight. The Regulatory Commission plays a vital role in scrutinizing the prospectus contents to protect public interest by ensuring all necessary information is presented clearly and accurately. Stock exchange regulations. Stock exchanges impose additional requirements, mandating that all securities offered publicly must be listed, ensuring that the company maintains high transparency and investor trust. Importance of accurate reporting. Accurate reporting in the prospectus helps cultivate trust with investors and is essential for maintaining compliance with ongoing regulatory obligations. We now move on to the timing and issuance of the prospectus. Timing of prospectus issuance. Process for future issuance. Future issuances may require a new prospectus for compliance purposes, particularly if significant changes in business operations or market conditions occur. Timing flexibility. Companies can issue a prospectus at various stages, including prior to business commencement, giving them flexibility to raise capital as required for growth opportunities. Business commencement considerations. If shares are not offered before the commencement of the business, a statement in lieu of a prospectus must be filed, underlining the company's intention and readiness for public investment. Nature of securities offered. Shares versus debentures. Companies can issue either shares or debentures depending on their financial strategy, with shares offering ownership stakes while debentures represent debt that must be repaid over time. Listing requirements. All securities must adhere to listing requirements established by stock exchanges to ensure compliance with broader market regulations, enhancing investment safety. Next, we cover the involvement of experts in the prospectus process. Definition and role of experts. Independence requirements. To ensure impartiality, experts must not have any vested interests in the company or its management, thus maintaining an unbiased stance on the veracity of the disclosures. Who qualifies as an expert? Experts include financial analysts, accountants, and legal advisors whose professional opinion is sought to lend credibility to the assertions made in the prospectus. Experts' consent. Consent changes. Any statement based on an expert's opinion in the prospectus requires their written consent, indicating that the expert agrees with its context and implications. Legal implications of statements. Expert statements included in the prospectus have significant legal weight, and any inaccuracies attributed to them can lead to accountability for misrepresentations. Finally, we address liability and compensation related to the prospectus. Criminal liability for defective prospectus. Consequences of misleading statements. Inaccurate or deceptive information in a prospectus can result in criminal charges, highlighting the importance of rigorous truthfulness and accuracy in disclosures. Offenses defined. Offenses related to prospectuses include making misleading statements or omitting critical information, both of which can lead to severe legal consequences for the involved parties. Compensation for misrepresentation. Rights of investors. Investors have the right to seek compensation from issuers, directors, or individual signatories of the prospectus for any losses incurred due to misleading statements or omissions. Liability of issuers and directors. Any party involved in the issuance of a misleading prospectus can be held liable for compensation claims from investors suffering losses based on incorrect information. As we wrap up, let's summarize the key takeaways and best practices to ensure compliance and success. Importance of a compliant prospectus. Building trust with investors. A compliant and transparent prospectus fosters investor trust, leading to increased participation in offerings and the potential for future fundraising success. Long-term benefits of transparency. Ensuring accuracy and thoroughness in the prospectus can lead to long-lasting relationships with investors, enhancing a company's reputation and market position. Future reforms and considerations. Evolving regulatory landscape. Future reforms may see changes in regulatory frameworks that enhance disclosure practices, requiring companies to adapt in order to remain compliant and competitive. Enhancements in disclosure practices. Continuous improvement in disclosure practices is essential, as it not only meets regulatory expectations but also aligns with evolving investor needs and market trends. Thank you for your attention. I hope this presentation served the purpose to help you understand about the company prospectus. For any further queries, feel free to reach out to course facilitator and comment below.